All right, let's kickstart the Money Show then. And joining me today on the show is Vivek Bajaj, co-founder of Stockedge and Elearnmarkets. Vivek, thanks so much for joining us today on the Money Show, and wish you a very happy Teachers' Day as well. It's admirable what you're doing today through your platforms to educate individuals and Indians on financial literacy, making them smarter with the markets, educating them on how to go about investing and trading. I suppose, this is one of the skills that's extremely important for Indians, and unfortunately we are not taught it at a young age. But it's great that you're trying to do that, from today on. And I can imagine that a lot of individuals, maybe making a beeline as well at your doorstep, considering the fact that the markets have been that one money-making machine that nobody is ignoring. So let's talk then about the fact that while some have approached you, many have also taken a very DIY approach to investing and trading. The last 1.5 years, as people spent more time at home, had more time on their hands, it gave them time to really look into the markets, educate themselves about it. What's your view on this DIY trend that millennials, Gen Zs as well, have gotten onto for learning, investing and trading?
Hi, so thank you for having me and for those kind words. Big congratulations for you also for this Teachers' Day. We all are learning from each other. We learn from you as well. If you see the last 2 to 3 years, what has happened, I always say this, that this ought to happen because the overall level of financial penetration in our country was so low. The understanding of the financial education, the financial matters was so low that this ought to happen. And COVID was more of a fast tracker, which led to everything happening very, very fast. As far as DIY is concerned, I would say that the new people who have come into the system, they are first-time investors. And first-time investor does not necessarily mean that millennials. There are people who are probably sitting in the fence and looking at the market, not very comfortable going into the market, thanks to a lot of baggages which we have seen in our market historically due to scams, etc. So there was a critical audience who wanted to get into the market, but they were there in mutual funds trying to be very defensive. They have also come into the system. So for me, DIY is not just millennials, but also the first-timers, non-millennials who have come into the market. Now, obviously, both these are very different characters. Millennials have extremely high propensity to learn. They want to take things in their control. They want the helm of the affair in the decision making. Whereas the people who were doing mutual funds, they believe that still a lot of advisors are there who can guide them properly. So they have rooted themselves to platforms where advisors are there. They have moved out of mutual funds and hosted themselves in platforms where advisors are still advising them. But millennials definitely have extremely high propensity of doing things on their own. So DIY trend is there and it's going to be there because millennials have just entered the system, and I don't see this as a temporary phenomenon anytime soon.
What do we often miss out in terms of nuances, when we try to learn something ourselves? Do you think that if you could just encapsulate the drawbacks as well? I mean, it's great when, you teach something yourself, but of course, it takes a little longer. I'm not saying that you don't learn comprehensively, but then if you learn yourself, you learn a little, and then you learn as you, make mistakes, etc. You learn on the job, as we call it that. So what do you think that, first-time traders and investors could miss out on when they go the DIY way?
So, the bigger problem with that DIY is that people assume that you just need those 5-6 months of intense learning and then you are sorted, which is not the case because this is not a course where you complete the course, you get the certificate and society brands you that now you are this, you can practice this. When you talk about DIY, it's a way of living, it's a mindset, it should be part of your lifestyle. And stock market or financial market, even you will acknowledge that it is an area which needs continuous improvement, continuous learning curve. So every 3 years, 4 years, market ecosystem is changing. So if I am DIY, I'm actually there in the learning curve forever. So that's the problem which I think people who are getting into the system in hurry, they don't realize. So we get a lot of requests that teach me options, teach me technical, teach me fundamental. I can give 1 month or 2 months for this learning. And we keep on saying this to them that it's a continuous process. We can ignite that fire of learning inside you, but if you don't have that desire to continue that learning forever, then this will fade down, this will die down its natural way, and then you will start blaming either the trainer or the system that things it doesn't work for a longer period of time.
Well, let's take trading and investing separately, because obviously both are actions that are very different from each other, require very different psyche as well. What we call as investment behavior too. Trading requires a different kind of psyche, and investing requires a different kind of psyche. So let's, I think, touch upon both those topics individually. Fundamental investors, what do you think are the traits required for fundamental investors, for long-term investors, if they want to get into full-fledged stock picking? What are the best ways that they can start off with, and how they can sharpen their skills as a fundamental investor too?
So what I have realized, that being a good fundamental investor means that you have kept your senses open. So your eye should always be open to observe new things. Your ear should always be open to observe new things. All your senses should be very, very active. So when I say eye, that means you should have this uncanny ability to read a lot, because identifying a new opportunities and going deeper inside that opportunities and to finally make a judgment on that opportunity would need a complete 360-degree understanding of that opportunity. So that will only come after you read a lot. Second is that you have to hear other people, what they are saying. So you need to be an extremely good listener. This is what I've learned from all the reputed investors of India. I mean, I have closely interacted with Ramesh Damaniji because he has invested in our company. And what a lovely listener he is, always hungry to listen from other people and then comprehending what you're listening from other people. So all your senses should be extremely active, and your assessment of micro details and then making a judgment out of that should be there as a habit. It can't be an option. It should be part of your habit. Whereas trading is a very different ball game, where you don't want to listen to other people too much. You want to create a framework of your own. For you, price is supreme. And if price is giving you some hint, you follow that hint. So for you, price is your friend. And other people are probably creating noise around your framework. So both are so different. And the way you approach both is very unique. I have not seen many people doing both things supremely well. I mean, there are a very handful of people. We know a couple of big names in our market ecosystem who have done so well, being a trader as well as investor. Otherwise, the way you approach the problem is so different in both these scenarios.
Exactly, yeah. I think that's very crucial to understand, and I'm glad you brought about the whole thing on listening well. This is something that I suppose is very, very crucial for all investors to do. You need to be a good listener. You need to grasp all the news flow as it's coming about. Excuse me. Let's now talk about trading. I think this is something that's a bit more trickier really to go about, because firstly you have you have a fixed time frame, and you need to make quick decisions within that time frame. The time frame, of course, being 9:15 to 3:30. What sort of a psyche, what are the traits that you think today a trader does require? I want to talk purely from the soft skills perspective, then we can get to the more technical aspects of trading. But let's talk first about the soft skills perspective. For example, you mentioned that listening is a very important trait among many other things for fundamental investors. What is a good skill for a day trader to learn?
So when we talk about trading, so there is one category which you mentioned called day trader. Then there are people who are swing traders. That means they don't have compulsion to trade every day. They will only trade when there is an opportunity. And then there is a category which is kind of a very closest to being an investor, which will be a long-term swing trader. Okay, so all three requires a different kind of a psychic. The most important differentiator which I have seen, and I also interact with so many traders because of my face-to-face series and other things, that the key differentiator is the belief system which each trader has developed with respect to their respective trading model. And that will only happen over a period of time with experience, because your temperament finally decides whether this particular trade or this particular situation which could be a profitable situation or a loss-making situation, how will you react to that situation? So for me, technique is 25%. 75% is temperament, which is the key differentiator between a successful trader or a not so successful trader.
Exactly. That's, I think, very important to do. Now, in the beginning, as you start off your trading and investing journey, you obviously are bound to make a lot of mistakes. So tell me, Vivek, as an investor, what are the most common mistakes that individuals do tend to make? And maybe not just in the beginning, later as well. For me, I think the biggest mistake would be not learning from your mistakes that you've already made, because then it's just a wasted mistake. But based on your experience, you teach so many students, what are the most common mistakes they tend to make?
The most common mistake is that people just want to buy everything. Because retail investors, we have this tendency of buying. And whenever we see bank balance available with us, our inclination to buy goes up. So most of the investors, they will have more than 50, 60, 70 stocks in their portfolio with a very small allocation to each stock, which does not make sense, because ultimately out of those 50, 5 or 6 will become super performers, and 5 or 6 will become absolutely dumb stocks, and rest will give you average return on a combined basis. So if you have lesser allocation for super performers, you actually don't generate too much alpha in your portfolio. So there should be a proper allocation of capital with lesser stocks in the portfolio and high allocation to convincing super performers. And obviously, as a super performer becomes underperformer, you should have that ability to exit from those underperformers so that the allocation quantum is lesser in the underperformers. That's pretty much the mistake which I see, that people do send me their Excel sheet, their portfolios, and one common thing is that they will have at least 50, 60, 70 stocks in that portfolio. That does not make sense for a serious investment.
Okay. What about traders, Vivek? And I think as a trader, you could make mistakes that are more expensive perhaps than a long-term investor. Would you agree?
Absolutely. I mean, accident can happen, while you are a trader, accidents can happen very frequently. In investing, you still have time to recover from the accident, but in trading, it could be lethal. So one has to be extremely clear what kind of trading that person is getting into.
Okay. So what kind of mistakes usually? I mean, is it that you start off with too small an amount or too large an amount? And also the biases. Usually I've heard a lot of viewers hold on to, just for example, mutual funds, holding on to mutual funds, holding on to different investment instruments with the hope that, okay, it'll turn a corner. Do you think that's the biggest bias that you face with a lot of young traders who start off their journey with you?
So every asset has a way to be treated. So, I mean, mutual fund, if you see an asset class, is predominantly meant to be an SIP candidate, because it's a forced saving which drives your allocation in mutual fund. So you can't stop SIP at any point of time in your life, because that's how the structure of mutual fund has been built. If you talk about other asset class like direct equity, and if you want to trade in direct equity, I mean, obviously you can't start with a lot of capital, because then if you have a lot of capital in your bank account, it is like you can see there is money there and you have that propensity to play with that money. Like in a casino, if you have a lot of money, you will be forced to play because the owner of the casino wants you to play. So always a structured allocation of capital, strategy wise, or piecemeal entry into the market with that capital. I always tell this to people that first quarter, put some small capital, see how it is happening. After end of the quarter, even if you make zero return and if your capital is intact, you're a winner. Then next quarter, add more capital, maybe similar kind of a capital or increase the capital, see how is it going. Then third quarter, add more capital. So don't be in a hurry to put all your capital in the market, because the propensity to over trade and over engage in the market will lead to, I mean, not that everyone lose money. There are people who have really made good money, but then the odd is not in your favor if you have too much capital from day one.
Okay, find a balance really. To start with, for new investors and new to the market individuals, Vivek, what do you usually start off your students with? Is it with trading? Is it with investing, or a little bit of both?
Well, I always communicate this to people who are my students that adopt a 10-10-10 strategy, which is, start with one stock for 1 month. And that one stock for that 1 month should be your life. So whatever you are reading, whatever you are observing, price action or fundamental and everything, it should be related to that one stock. Okay. And then next month, add one more stock. So you have 2 stocks after end of 2 months. Then third month, you have one more stock. So over a period of 10 months, you have 10 stocks and you have become such a good friend of these 10 stocks. Just imagine you're spending one full month with one friend, having lunch, dinner, everything with that friend. How much you will be able to know about that friend, and that friend will become such a good friend with you, if at all that friendship has to happen, or the friendship will get broken and thank God you then will not continue with that stock. But typically, if you have 10 friends over a period of 10 months, you are sorted in life, because if the price has to go up, your friend will tell you, hey, buddy, I'm going up. Or if the price has to go down, you will get the hint from that stock itself. So identifying the stock is important, and this is how you do that. Second is obviously whether you trade or invest is totally dependent upon your risk appetite. There is no right answer for that. Some people are comfortable trading. They have stronger nerves, their risk appetite is strong. So I always ask them, yes, do trade, because if you don't trade, you don't feel part of the market. So maybe 25%, 30% of your time as well as resources should be allocated for trading, and 70% would be for investment. Some people prefer to do trading first. So when I started, I was trader first, and then I saved money out of trading and got into investing. So it's totally individual driven. There is no right or wrong answer to that question.
Okay, understood. It depends person to person. It depends on your risk appetite, the time as well you have to devote, to your investing activities. Because remember, trading will require much more hours, much more commitment, much more tracking by you as well. Now, what is the most commonly asked questions that traders and investors ask you, apart from, the trick to making a lot of money, Vivek?
So the commonly asked question is how much return I'll be able to make from market. And the expectation is obnoxious. Everyone wants to make a lot of return on a daily or weekly basis. And people don't understand this concept of CAGR. In fact, I did try to explain people that it is not about making a return every week, or you will lose money some weeks. That's how the market structure is. So when you have to evaluate your performance in market, it has to be CAGR. So define your CAGR target, that whether you want 20%, 25, 30, 35, 50, 100, everything is possible in this mighty market. The more you target higher CAGR, obviously you have to go to higher risk strategy, which should not bother you, because if you want higher CAGR, you are ready to commit higher risk capital, and if it goes bust, it should be okay with you, because anyways you are mentally prepared to go aggressive into the market. So first thing first, everyone please target what is your expected CAGR from the market, and based on that CAGR, define your participation in market. And this is scientific, very much possible. It's just that before you get into the market, you should do that 2-3 months of introspection, brainstorming, and then find out that this is the right way to look at it, and then get into the market, rather than someone is asking you to open an account and you open an account in a hurry. Then you get a broker's email that, hey, you have opened an account, now what about money? Send me money. And then you give your money, and then the trading terminal is right in front of you with all those color changes, which excites you to trade a lot, which is not the right way to approach the market.
Okay, Vivek, this has definitely been a very enlightening session, and for all those who've still not started investing, I think you've provided a great guide, especially for new traders. Start off with one stock. So that gives you a sense as well of how to go about it. You learn a bit more when you start off small, and then it gives you the ability to be more well equipped to deal with a bigger portfolio. Vivek, we leave it at that. Thank you so much for joining us in this very special episode of The Money Show.
Thank you so much for having me. Bye-bye.